All right, everyone. So I'm going to show you in this video my Forex trading strategy when I'm going into deep fundamental analysis using macroeconomic data to generate high quality trade ideas. Okay, I get a lot of people asking me, wow, these spreadsheets that you show on your videos, they're very in depth. So I'm literally going to walk you through a few winning trades I took with my members recently. I'm going to break down the bond market, interest rates, government bonds, inflation data, central banks, basically how we're analyzing the United States economy and why the dollar got very strong against a basket of currencies, including the Canadian dollar also was another currency I traded because of oil prices going up. So I'm going to take you on the screen, update these spreadsheets and show you how you can start to generate high quality trade ideas using economic data and Excel spreadsheets. All right, guys. So let's start this webinar today, okay? So what we're going to do today, I basically wanted to actually just educate you guys on the process of how I'm basically finding trades, basically. All right, in the last few weeks, since we started this new challenge, we've had 3 winning trades, we've had 1 losing trade, and we've got more trades to come, of course. And basically, I have to update my spreadsheets every day, try to find trades. And I thought for you guys, it'd be very educational for you guys to basically go through the process with me and show you how we're trying to find winning trades to take in the market. So, firstly, what we're going to show you now is something called the COT report, right? This is a really interesting report that we use to understand how hedge funds are positioned in the markets, basically. It will show you how many contracts hedge funds had to buy the pound in the options market compared to how many contracts are to sell the pound in the options market, or the euro or the yen, whatever. And basically, this report tells you how positioned the hedge fund manager is, or the hedge fund managers are, sorry. Okay, it's called the Commitment of Trades report. So it basically tells you how committed traders are to buying or selling a currency, okay? So if you have a look at this spreadsheet here, when we're looking at all the countries, what I do is I always have this report over here, and basically it's showing me whether hedge funds are net long or net short a currency. Okay, so anything minus means there's more contracts to sell a currency, and anything which is above 0, so 2.3, means that at this moment in time, from the last time I updated these spreadsheets, hedge funds were net buyers of dollars. And as we know, the dollar's been getting very strong in the last few weeks, hence why we took some dollar trades and we made a nice profit. So I'm going to basically walk you through, guys, do this COT report, and then we're going to look at the economic data, oil prices, bond yields, gold's price, why has bond market's been going up, why stock market's been going down, trying to figure out exactly what's going on. Okay, so when we're going to do the COT report, what I'm going to educate you guys on is basically you're taking the total amount of leverage long positions, total amount of leverage short positions, then you've basically got the difference between the longs and the shorts, to the change in difference, the change in the amount of contracts week by week, and then you have a percentage of net longs and net shorts. And the flip is basically the percentage difference of the two. So whenever you see, for an example, this brown line represents the flip, and the flip represents whether the hedge funds are committed to buying or selling a currency. And as you can see throughout history, look at the currency pair. This is literally looking at the euro against the dollar. Can you see that the euro dollar goes higher? So the euro goes up in value against the dollar. No surprise when the contracts of hedge funds to buy the euro are going up. So you can see here when it goes from being below 0, this is when the market was net sellers of the euro. So basically they were selling the currency. And then when they turn into buyers, no surprise, it's coming from this trend of hedge funds getting more and more bullish on the euro. And then the currency pair follows. And then what happens? The COT report starts to go negative. Notice how the COT report starts to go negative and show that hedge funds are now selling the euro before the euro USD exchange rate turns over and starts to go lower. So the COT report is a leading indicator telling you how hedge funds are positioned in the market. As you guys know, the big speculators, when they're putting their money to work, it does move the markets, and they're smart money. So they're investing for fundamental reasons when they're trading. So let's figure this out. Okay, so what we're going to do, I downloaded the data, and we're going to update the data in the spreadsheet and try to figure out what's going on. Are they buying or are they selling? So the last day I updated for the Canadian dollar was the 19th of the 9th. Okay, so we've got 2 I didn't update it last week, so I'm going to update both of these reports now. So I'm going to put the latest one after the 19th and the 26th, and the latest one. So now we're going to be able to see our hedge funds buying or selling the Canadian dollar. They're net sellers right now, okay? We did buy the Canadian dollar against the Japanese yen, and we did buy the Canadian dollar against the pound, and we made money, but that was fundamentally because of oil prices going up. So we did win those two trades about a week ago. Okay, so you guys remember we bought Canadian dollar JPY, we made a profit, and we sold the Great British Pound against the Canadian dollar, and we made a really good profit on the way down. We've had a rebound since, but we got these two wins in, but that was all to do with oil prices, okay? So even though oil prices were rallying higher, and you can clearly see here, guys, can you see how when oil prices shot up from $82 a barrel all the way up to $94 a barrel, look what happened. That's when the Canadian dollar got stronger, and then oil prices rolled over and the Canadian dollar got weaker. But no surprise, today oil prices are higher. No surprise, Canadian dollar is stronger. So oil prices obviously have a big impact on Canada because Canada's key export is oil. Okay, I'm only just showing you this because I do want you to understand that hedge funds, if they're net sellers, that's because they have a bearish view on the economy of Canada overall. Okay, but commodity currencies can go up and down in value, even if their economy is a little strong, because the commodity they're selling can go up in value. As a prime example, here's the effect of crude oil, right? And the ISM manufacturing. But we'll move on to this in a second. But let's just see. So currently, Canada, they're net sellers. So I need to update the latest 2 weeks, put it on the spreadsheet. Okay. So how many months? So what was the last one I had? Minus 7.9. Okay. So these are the last 2 weeks for Canada. So it does help, guys, to see how the hedge funds are positioned. Now, it doesn't mean, as you guys know, even though the hedge funds were net sellers, I still bought the Canadian dollar. So what I'm saying is, even if the big community of money managers are not buying the currency, but you can see an opportunity to buy it, you can still take the trade like I did. And we made money together because I know about oil prices and Canada's key export being oil. Okay. And again, if you want to learn more about this, literally all you have to do is go over to the OEC website. You can do this for any country, guys. Go to the website, click on this search bar, type in a country's name, right? If it wants to load. I don't know if it does. Yeah, why is it not coming up? That's strange. Usually it loads quickly. Okay, I don't know what's going on. I've done a video on this showing you guys how the Canadian dollar goes up and down in value when oil prices go up and down, as I showed you over here. Okay, the key export is oil. So when oil prices rise, Canadian dollar strengthens. Okay, when oil prices fall, Canadian dollar weakens. When it goes up, when oil goes up, Canadian dollar again strengthens. This is the Canadian dollar against the pound. But I mean, you can pretty much see the same situation with the Canadian dollar against other currencies. Okay, so look, when oil prices went up here, the Canadian dollar strengthened against the US dollar. And then as soon as the oil price has gone down, the dollar shot up against the Canadian dollar. And then today, oil price has gone up, the Canadian dollar's got stronger against the US dollar. So you can see that correlation between the pound, the US dollar, or any currency pair, okay? CAD, JPY. All right, so okay, so currently markets are net sellers of Canadian dollars. So if we're going to trade the Canadian dollar, we have to always trade the currency based on oil prices. Otherwise, we should look at why the fundamentals are pointing towards a weaker Canadian dollar. Okay, and we'll go through that shortly. Let's just finish off this spreadsheet. So now let's look at the Swiss franc. Okay, what are markets doing with the Swiss franc currently? All right. Let's have a look. Okay, let's continue to build out our spreadsheet. All right. Swiss franc. Okay, so currently investors, the investment community, hedge fund managers, they're net long, so they're buyers of the currency, the Swiss franc. So that's a positive for the currency. There's obviously a fundamental reason, and it's because the Swiss National Bank has been raising interest rates from their negative, I think it was minus 0.75%, actually, even a more of a negative rate than Japan, but now they've gone positive. So that's obviously been a big positive for the Swiss franc. And if you have a look at that, let's look at Euro Swiss franc all year and last year as well. See, look, we've had a stronger Swiss franc for quite a while now. The Swiss franc has gone up in value against the euro by around 5%. Not massive moves, but there's been a lot of appreciation in the Swiss franc. Even since 2022, look, the Swiss franc has gone up in value against the US dollar by around 10%. Okay, that's because of interest rates in Switzerland going up. Swiss franc JPY, Swiss franc's definitely got a strong against Japanese yen. Yeah, look at that. Boom, big move. Okay, so look, Swiss franc has gone up in value against the JPY by around 20%. That's a big move. All right, so as you can clearly see, guys, there's been a strong currency for the Swiss franc for quite a while. So they're net buyers in the Swiss franc. What are the investment banks doing with the pound currently? Last time I checked, there were buyers of the pound. All right. But as I said, guys, even if like you could look at these spreadsheets and stuff, and it's good to just understand what the markets are doing. But if you have your own view on a currency, which can cause you to buy the currency, then fucking buy it. I mean, only a few weeks ago, we was buying the pound a lot and we was making a lot of money. We won quite a few trades trading the pound. And that's because the market's expectations for interest rates going up in the UK, but that changed recently when inflation data started to go lower. So we stopped trading the pound because we think interest rates have hit their peak in the UK. All right. Where's that spreadsheet gone? All right, cool. So the UK, Great British Pound. Okay, so let me just double check that the last week is not actually, it's the last week, not actually October. It is October. I thought it was. So basically, what I need to do over here, this needs to be October. I did too many September months, so that's actually October. That's actually October. So what I'm going to do, guys, I'm literally going to walk through this. So to quickly update the spreadsheet, because it's really important before we get in any trades, we need to know, okay, what are hedge funds doing? Are they buying the currency or are they selling the currency? Because if you don't really know what's going on, you could be buying the currency, taking a trade, and you don't realize that all the fucking big money around the world is all going the opposite direction. And you don't want to get caught out in a trade when the hedge fund money is basically positioned in the opposite direction. So you need to make sure that if you do have a view to buy or to sell a currency in the opposite direction, then you have to come out of a logical reason. Why is your view completely different to everybody else? Basically, that's what this report can really help you do. Before you get into a trade, you have to come out of a sound, concrete reason. Okay, and that's why I always talk about technical analysis not really being a long-term winnable strategy, because unless you can articulate and explain why your trade is going to go up or down, not just looking at a chart, because if all the hedge funds around the world are buying a currency, there's obviously a reason behind it. They're not going to buy and sell a currency for no reason. There's a fundamental reason why, right, this currency is going up and down in value, and you got to fucking understand it. Does that make sense? So right now, Japanese yen, investors are sellers of the currency. And we've known that for a while. The yen's been fucking weak as hell. That's why we took the trade for... We've taken so many yen trades. It's unbelievable. Look, if I just go through that whole list of all the winning trades we've had, there's been so many that were yen trades. I mean, let's go through the list. 1 winning trade, 2 winning trades, 1 lost, 1 loss, win, 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 loss, win, win. So more wins than losses, but definitely been trading the yen a lot. I missed some out here as well. Quite a few wins here. yeah, there's been a lot of trades we took it against the Japanese yen, and it's all down to low interest rates, guys. Okay, so the fundamental reason that investors have been selling the yen is because interest rates in Japan are very, very fucking low. Okay, like look at the difference between the interest rate on the Japanese government bond, 0.79%. 0.79%. Interest rates in United States, 5%, basically, 4.75%. In England, 4.62%. Canada, for an example, what's the latest month in Canada? 4.19%. So just think about it, guys. If you're an investor, where are you going to put your money? In Japan? No, obviously not. Why would you go and put your money in Japan and get paid 4% interest when you could go put your money in the UK and get 3.5%, or go to the US and get 5%? Okay, so you can see, like, look at New Zealand's rate, even higher than the US on the last one, 5.58%. New Zealand's got a higher rate than the United States right now. So think about it. What are you going to do? You're going to put your money in Japan? No, obviously not. So the low interest rates in Japan is the reason why, as other countries are raising rates, like Switzerland, like the UK, stronger pound, like the US dollar, stronger dollar, like New Zealand dollar, stronger currency, Aussie dollar, stronger currency. So that's the reason why Japanese yen's been weak. Look, all these currencies are going up against the yen. The yen's the last, Japan is the last major central bank on earth to have interest rates at zero. But that may change quite soon, because the markets are expecting the Bank of Japan to potentially move away from negative low interest rates. So that's the interest rate on the government bonds if you borrow money to the Japanese government for 10 years. But the interbank rate is basically minus 0.1. Okay, and that's basically the interest rate when you're trading Forex that you're charged or you're paid to buy or sell a currency, which I'll break down a bit more in detail. So yen, negative. Investors are not buying the Japanese yen. The euro, what's happening with the euro? Take this data, slap it in. Very low, 1.9. You might as well just say the markets are not biased in any direction on the euro. But as we know, the dollar's been battering the euro, battering the currency. If you put that order in to try to catch a sell position and still think it'll play out, just have to be a bit patient. All right, so euro. Okay, so Aussie dollar. What are investors doing for the Aussie dollar? For the Aussie dollar, we have to look at iron ore prices, the key export of Australia. What's happening with iron ore? Let's get a line chart. Can't really see it when you do this. Okay. Prices have actually been rising recently. So let's see what's been happening with the currency. Okay, so we can see here iron ore prices went up. At the same time, we saw some appreciation in the Canadian dollar. It's gone up around 3%. It did go up to around 4% at the peak of the iron ore price here. Okay. Again, look here. We saw the big leg up in the iron ore price here. And look, Aussie dollar shot up at the same time against the Japanese yen. So you can see this here. And then when the iron ore price didn't go up, it just kind of flatlined. That the Aussie dollar couldn't go up any higher. So there's a really good example, guys, of the Aussie dollar getting stronger and weaker based on what the iron ore price is doing. Iron ore is used to make steel. Steel is used for construction. China buys pretty much 80% of Australia's iron ore. China's going for a property crisis at the moment. So look at the bigger picture. Iron ore's gone down since April 2022. Iron ore is sold in dollars. No surprise. Look, that's when the Aussie dollar started to lose a lot of its value against the US dollar. When iron ore prices started to fall at exactly the same time. Look, iron ore prices bottomed here and then started to rise. No surprise. Aussie dollar strengthened against the US dollar. Exactly the same time. Iron ore prices again started to slide. Aussie dollars got weaker against the US dollar. So to trade the Aussie dollar, we have to look at iron ore prices. To know what's happening with iron ore prices, we have to look at China. If we know what's going on with China, then we can get a good idea as to what's happening with the Aussie dollar. So guys, as you know, you can see, man, it's a lot of fucking work, man. To understand how to get these trades on, it does take a lot of patience trying to make sure we can get some high quality trades and not trying to just like be impatient and gamble. So all right, let's finish off this spreadsheet. Aussie dollar. After this, we're going to look at the bond market. We're going to have to update the yield curve to understand what the bond markets are predicting for the economies of Europe, the US, for an example. It's long, it's tedious, it's boring. But hey, it has to be done, man. Otherwise, take trades and keep fucking losing. Keep trying to lose, trying to make money, trying to get rich. All right. September, October. Mexico. Mexican peso should be getting weaker. Markets are pricing a lot of interest rate cuts. Look, I updated the spreadsheet today. Interest rates. Look at Mexico's interest rate expectations over the next year. By December 2024, rates are going to go from 11.25% down to 9.5%. So that is basically nearly 2% interest rate cuts expected by the end of next year. 2%. And in the US, there's only 75 basis points. So 0.75%. Has the US dollar been going up against the Mexican peso? I'm sure it must have. Yeah, it has done recently. Yeah. Kind of thought so. This could be a new trend. I put a new alarm here. I put an alarm here on TradingView to catch this if it moves up. If it does, I'll buy it. We'll buy USD Mexican peso, try to catch this big move. If we get a profit in, happy days. But if these interest rate cuts are going to come in Mexico, as the markets expect, we'll see a weaker Mexican peso. So that could be a good idea to sell the currency. Okay, so Mexico. Let's do Mexico. So 26. Okay. So at the moment, the market's a net buyers of the peso currently. So if you want to become net sellers and actually start to buy the dollar against the peso, well, maybe you want to see the contracts turn negative. Okay. Maybe that would be the time to catch these contracts turning negative. But if we see these contracts going lower and lower, so let's say they go from 16, then in the next few weeks, in the next few months, you start going down to like 15, 14, 10, 8. And as the contracts are going lower, you keep seeing this trend pushing up. Well, you don't have to wait for it to go to negative. If you understand the fundamentals behind why it's going up, we can get in early. We could just fucking take the trade. I'd rather get in early than wait and miss the fucking move, you know? So, yes. Brazilian real, another country where markets expect interest rate cuts to come in quite rapidly. I keep reading about this on Bloomberg. Brazilian central bank is expected to cut rates quite aggressively as well. By October next year, they expect to go from 13.15% down to 11%. So big moves expected in interest rates. The dollar hasn't really traded that much against the Brazilian real. The dollar's lost 11% of its value against its currency. So since 2021, guys, can you see? We've seen the dollar lose this much value against the Brazilian real since 2021. At the same time, the US dollar went up in value against the Japanese yen by 45%. So why did the US dollar go so much higher in the value against the yen, but not against the Brazilian real? Guys, interest rates. This is a prime example. Interest rate differentials. The dollar has a very high interest rate relative to Japan, and Japan is the number one owner of US debt. Japan owns the most US debt, but not just the look, the dollar went up against the Aussie dollar. The dollar went up against the New Zealand dollar. The dollar went up against I'm guessing the Canadian, yeah, went up against the Canadian dollar. The dollar went up against the Norwegian krona. Look, you can see here. But why not the Brazilian real? Because the dollar has a higher interest rate than all these other countries, right? In Brazil, it doesn't. Look at Brazil's current rate of inflation. This is really good for your education, guys. Look, inflation in Brazil is 6%. The interest rate on a 10-year government bond, as a prime example, is 11.95%. 11.95%. 1, 2, 3, 4. So, whoops. So this is going to have to go 1, 2, 3, 4. It's going to have to go here. 11.95%. So if you adjust this interest rate minus inflation, you're getting a real return of interest over inflation of 5%. That's fucking good, right? You're making nearly 6% interest on your money over inflation. In the US, you're only making 2.36% over inflation expectations. So clearly, investors have been looking at Brazil, selling their dollars, buying Brazilian reals, parking the money in Brazil. That's why the dollar can't get stronger against the Brazilian real, because investors are definitely rather buying reals right now. But if these interest rate cuts do come in Brazil, as the markets expect, we're probably going to see the US dollar shoot up in value against the Brazilian real. So that's just something to look at. Obviously, we don't just have to trade USD Brazilian real. We can trade absolutely anything against it, but it's just good to understand the psyche behind the markets. So let's go to Brazil. Let's update this. It probably takes me, if I'm doing like all the spreadsheets, about 2-3 hours to go through everything. It won't take that long on this webinar, guys. Oh, look, guys, look. Investors have already turned net short on the Brazilian real. That's interesting. So look, investors, the hedge funds have already started to position themselves to sell the currency. You can see it in the data there, see? That's interesting to know. So now you know investors have gone from being long to short. Look how high it was just 2 months ago. 28.32.6. Now it's gone all the way down drastically. Oh, sorry. They are net long, sorry, 7.5. But look how much that's decreased. That's clearly telling you something. Why have investors started to unwind their positions? They start to sell their positions and close the trade. Obviously, they know the interest rate cuts are coming, so they get out the trade quickly. So that's something to look at. That's interesting. Let's look at New Zealand dollar. Let's see what they're expecting for the New Zealand dollar. So yeah, guys, if you're going to trade currencies, if we're not watching the COT report, fucking hell, that's very risky trading, man. Because we're not going to have a fucking clue what some of these Ray Dalio's hedge fund, Bridgewater, they could have fucking 10 billion set aside for currencies. Do you know what I mean? If they're putting on a trade, trust me, that's going to move markets. So we need to understand how are they positioned. Otherwise, we're quite difficult training against these boys. All right, so New Zealand. So at the moment, markets are net long the Brazilian real. The South African rand. What are markets doing with the rand? And just remember, guys, when it comes to currency, there's one thing that moves a currency: interest rates. Simple as that. And more importantly, the real rate of interest. What is the interest paid on government bonds, for an example, adjusted for inflation? And what's happening with the stock market in that country? If the stock market is ripping higher, everyone's going to put their money in that stock market. So what they're going to have to do to put their money in that stock market, buy the currency. So I'll show you moves. I'll show you moves on these spreadsheets where interest rates in the US was higher than Europe at one period, but the European stock market started to go up because Europe was going through a period of growth. And I'm going to show you on these spreadsheets. And then the euro started to rally, even though the US had a higher rate than Europe. So stock markets can also push up currencies as well. I'm sure you guys are starting to see, like, when I'm saying, guys, be patient for trades, you can see why, right? There's so many factors that plays into a currency going up or down in value. It's not just like, oh, yeah, but the chart's going up, just buy. Because if you do that and you don't even understand why the chart's going up, you might try to buy and then that could just be a pullback within a long-term downtrend. You get caught out, lose money, you feel like a fucking idiot. So that's why sometimes we go through these periods. Like, as I was saying to you guys, now we're now waiting for this US data on Wednesday, this jobs data, this inflation data to see how to trade the dollar. Do you know what I'm saying? Otherwise, we're not really trading, we're just gambling. All right, so for the dollar, we have to go down and we are looking for there we go, the dollar index. I'm expecting hedge funds to be long dollars because of these surging bond yields. Let's see how the markets are positioned right now. They were long last time. Yep, look. So clearly, guys, look, we've seen in the last 4 weeks, investors have got more and more bullish on the dollar. And if you look at the dollar in the last 4 weeks, what's happened? Yeah, so look, last 4 weeks, last 4 or 5, the dollar's been getting stronger, stronger, stronger. So let's have a look here. Yeah, so investors have turned more and more bullish on the US dollar recently, which is good. Okay, so now we've got all our data in. That's one key component coming in here. Okay, so now we know how the hedge funds are all positioned. So we want to be buying dollars. We want to be buying the New Zealand dollar. If we're going to be long, maybe the Mexican peso. Investors are not buying the Aussie dollar, and we've already seen it's very low. The euro is there's no conviction behind the euro. The yen, investors remain sellers of the yen. The pound, investors are long the pound. Okay. Swiss francs, not really conviction towards Swiss franc. Canadian dollar, they're net sellers. Okay. Now, Oil prices. We have to look at oil. We have to look at, for oil prices, what's happening with the manufacturing data, because that's key for oil. All right. So let me close this now. We've done the spreadsheet update. And that data for the COT report comes out every Friday. If you guys want to learn how to do that, I do teach this in my course, my online course, my website. There's a whole video teaching you about this COT report in more depth, how to get the data, how to download the spreadsheet, how to update it yourself if you want to be a full-time trader for yourself. Okay, so when did I last update this spreadsheet? July. Shit, it's been quite a minute. Let's update this more often. Okay, so easy to update this. Just come over here. Let's steal the manufacturing data from the US here. January till now. Go back here. Let's take. Okay, so now let's take the oil price as well. So obviously you guys know oil prices goes up and down based on supply and demand. At the moment, oil prices had been going up. So the reason we bought the Canadian dollar and those two trades I was talking to you guys about was because oil prices shot up, as we can clearly see here. Oil prices shot up, okay? And we saw the Canadian dollar get stronger, and that's why we took those trades. And why did oil prices go up? Because Saudi Arabia and Russia have purposefully cut the supply of oil, whilst the demand for oil had been getting stronger or remaining strong. If there's a certain level of demand and you cut supply, prices go up. So they push up the price of oil on purpose, but then because of these US government bond yields shooting up recently, and as you guys know, as interest rates on bonds keep going higher and higher, everything in the country of the United States and all the interest rates around the world, the 10-year government bond is the benchmark. So when a company borrows money, they have to borrow money over the rate of a 10-year government bond. So basically corporate yields, maybe this is the US, they call it the risk-free rate because the chance of the US government not paying their debt is zero because they can just print more money or they can tax their citizens if they need to get the money. So the risk-free rate in the US is 4.7%. I will literally show you right now the corporate rate of borrowing money for the safest companies. This is really interesting if you guys actually learn. Let's do this. Fucking massage, man. My back's killing me. All right. Where do we go to get this data again? There we go. So companies that are AAA rated, yeah, the safest government corporate bonds you can buy, the Apples, the Amazons. So their interest rate average is 5.41%. 5.41%. 5.41%. Okay. The US government interest rate on a 10-year government bond right now is, as we looked at here, 4.56. So there's a 1% premium on top of the government bond for the safest bonds in the world. Apples, Amazons, fucking Microsofts, Teslas, all these companies that borrow money, they borrow money at a percentage point above government bonds. Okay, then you got like triple B companies. What's their rate of borrowing interest? 6.48%. So that's 2 percentage points over government bonds. So they have to borrow money at a higher rate. Why are they triple Bs? Because maybe they're riskier companies that maybe they don't have the best financials like the Amazons. And then triple Cs, which are seen as junk bonds, look at their interest rate, 14%. 14%. All right. So when companies borrow money, it's over the risk-free rate, which is a 10-year government bond. Then you have credit cards, car loans, student loans, etc., etc. So when these bond yields were shooting up, the markets got scared and said the demand for oil is going to fall because the US economy may not be able to handle interest rates going up so quickly, because everyone's interest payments are going to go up dramatically. And people who have student debt, for an example, a lot of it's on variable interest rates. So as rates go up on a 10-year government bond, interest rates across the country on everything go up. That's why this bond is so important. Okay. So can you see over here, guys? We had oil prices going up. Okay. Because as you can clearly see, bond prices really peaked and it didn't really go anywhere. They kind of just went sideways from October last year until here. But then look what happened. Soon as the bond yield took off, here. So when the bond yield took off here, no, let me show you. Yeah, so there was consolidation around here. It wasn't going anywhere. And look, soon as the bond yields took off here, that's when oil's price tumbled. Can you see? Exactly the same time. That's when oil prices went down, because the demand for oil was driven by the growth in the US economy. Why? The US is the biggest economy in the world. So what I'm going to show you now in the spreadsheet is, when we look at the price of oil, it's funny that the price of oil is always following the manufacturing data in the US, because the manufacturing data in the US predicts growth in the US economy with an 85% certainty, going back to 1950. So I'll show you right now. All right, so what was July's price? 85.43, 85.43, 86.83, 86.8, 95.31, 88.06. So if we now open up the spreadsheet again, now let's look at, okay, can you see for our history? Look, the blue line represents what's happening in the manufacturing sector in the US. Anything below 50 indicate the manufacturing sector's in contraction. What happens to the price of oil? Tumbles. Soon as the manufacturing data starts to grow again, indicating the manufacturing sector, which makes up 20% of companies in the US, starts to go through growth, what happens? Oil demand goes higher. Okay, can you see that? Oil prices go up. Look at the blue line and look at the orange line. They literally marry each other. They follow each other up and they follow each other down. They follow each other up. They follow each other down. The manufacturing data recently has started to turn higher again in the US. No surprise. Oil takes off. Obviously, there is the supply element to it as well. But basically, now you know what really drives oil prices. If you can get a good view on the US, you get a view on oil prices. Why? Because the US is the world's biggest economy. It is a net importer of goods. So when the US goes through growth, they buy all these goods from all these other countries and they help the rest of the world get richer, because the US runs a deficit because they spend more than they take in, basically. Cut a long story short. Let's look at the US, if it comes up. I don't know what's going on this website today. Usually it's sharp. Okay, so oil prices have been going up, for an example. Now, what happens with oil? Give us an idea of what we can do with the Canadian dollar. Maybe we can even buy oil prices. It all depends. Okay, so recently also as well, we've been seeing what's happening with gold prices. We're watching gold. Basically today is, well, as you guys know, I'm sure you saw in the news, Israel's at war with Hamas in Palestine. God bless them Palestinian people, man. Feel sorry for them. Anyway, as you can clearly see, you've seen, for an example, the 10-year government bond yield going up and gold prices going down. So look, all we need to do to trade gold is you need to know what's going on with the bond market. Okay, but today we've had safe haven demand in gold because of what's happening in the war. But look, as you clearly see here, as the interest rates of government bonds was going up, gold's price on the left-hand side was going down. Can you see that? Look, bond yields go up, gold goes down. Why? Because the higher interest rates go on bond yields, on bonds. So the more interest, and sorry to not explain this, yields. When I say bond yields, I'm basically saying bond interest rates. The interest rate of the government bond. That's what yield basically means. For all of you who may not know. So, look, notice as the interest rate has been going up in the US on the 10-year government bond, and then when you take that interest rate and you then subtract where inflation is expected to be, yeah, we're looking at inflation expectations. If the interest rate keeps going higher on a 10-year government bond, but the inflation rate, remains where it is. So you can see quite clearly, inflation has been around. They've been predicting inflation by around 2.5% since January. Look, every month, inflation expectations haven't really changed, but the bond yields have kept going higher. So the real rate of interest has been going up and up and up and up. So that's why investors are buying dollars. That's why the dollar is getting so strong. That's why you're seeing all these moves, guys. All these moves we're seeing, Euro USD. Sorry, let me do it here. All these moves we're seeing here. USD getting very strong against the euro. No surprise. Look at the bond yields. At exactly the same time, the bond yield shoots up. Because the US is paying a better real rate over the expectations of where inflation in Europe's going to be, the UK is going to be. Look, when did the pound start sinking against the dollar? When bond yields started to go up. When has the pound made a little recovery against the dollar? When bond yields have stopped going up. You see, the bond market literally fucking drives everything, guys. The bond market's the key. If you're going to trade currencies or even gold, like I'm showing you, it's all about interest rates, right? So going back to gold, what I was trying to explain to you guys is that investors only buy gold if they can't buy government bonds, which protect them against inflation, right? So if we go back to this period here, after COVID in 2020, look what happened. Okay, let me just show you what happened. We all know what happened. Go up here. So 2020 happened. COVID. Central banks slash interest rates quickly to try to save the economy from this breakout of this virus. So look, in January, rates are 1.5%. By March, when COVID breaks up, they slash rates to zero, basically, right? So look, March, that's when interest get cut to zero in March. This was an emergency meeting. Notice how on March the 3rd, rates were at 1.25%. By March the 15th, 2 weeks later, they cut rates. That was an emergency meeting, right? March the 15th. Can you see here? March, that's when the 10-year government bond yield sinks. So it was paying 1.5%. And then by the end of March, it's paying 0.29%. So from here, look at the price of gold, okay, when interest rates go from this level here down to here. Look at gold go up this whole time. Gold goes up, gold goes up, gold goes up. You see this huge rally in gold. Boom. Gold goes up 38%. Why? Because now investors can't get protection from inflation in government bonds. What are they going to do? They're going to buy something else. What are they going to buy? Gold. And they bought stocks. Because low interest rates always pushes up stock markets as well. So stock markets rallied, gold's price rallied. Okay. And then what happened? Notice how when the bond yields bottomed, gold peaked. And then here came the climb of the bond market. Inflation was getting higher and higher. Bond yields started to rise because investors wanted more protection over that inflation. Okay. And then, boom, takes off. Bond yields keep climbing. Okay. Bond yields make a recovery. And notice how when bond yields make a recovery, gold's price doesn't go anywhere. It's flat from August 20 to March 2022. For 2 years, gold's price doesn't go up. It goes down and comes back up. But it's only then once the bond market really takes off in February 2022, because that's when the US central bank started to raise interest rates. As you can clearly see here, when was the first hike? Sorry, March 2022. That was the first rate hike. That's when, look, March 22, bond yields shoot up, now giving investors more and more protection against inflation, and gold's price sinks the whole time. It goes down the whole entire time. Until what happens? Bond markets peaked here, and then bond yields went down. Notice straight away, gold's price goes up. Same thing. And then when bond markets stopped going down and then started to recover and go back up again, gold price went down. So basically, if we're going to trade gold, basically, in a long story short, guys, we just have to look at the bond market. That's basically the point I'm trying to get at. We go watch the bond market like fucking hawks. And basically, why has this bond market shot up recently? The US has a lot of debt. They're going to print a lot more money coming up because they need to basically put a lot more money into the military to fight off China's threat. They're spending a lot of money on infrastructure in the US right now, and they have to borrow a lot of money, but they've got a lot of debt already. Investors are getting nervous. You had a credit agency just downgraded the US from being AAA rated to now AA rated, I think it is, Moody's, because the US nearly had that government shutdown, and they keep having these squabbles in Washington about budgets and everything. And investors basically are not wanting to buy the debt right now. And so there's an increased supply and there's not enough buyers, and the bond market is shooting up. And now investors are also expecting interest rates to remain higher for longer. So they're also repricing interest rates higher on government bonds because the rate cuts they were expecting are not coming. So that's why the bond market shot up. So that was why we took the sell trade on the S&P, expecting bond markets to keep going up. But unfortunately, lost that trade. Happens. It's part of the game. So yeah, you can see at the same time, look, guys, when the bond market started to shoot up, stocks went down. Okay? And previously, when the bond market reached a peak in October and started to go down, stocks went up. Because the interest rate on a 10-year government bond, the real rate of interest I keep talking to you guys about here, adjusted for inflation, they basically use that calculation to value the future earnings of companies. It's called the discounted cash flow. You can go research it. So basically what I'm saying is, if we're going to trade stock markets in any direction, we got to watch the bond market. And the bond market is always being driven by the expectation for where the Federal Reserve is doing with interest rates. Currently, right now, by October next year, the markets predict rates to be down to 5%. So 0.25% rate cut. By the end of the year, 4.79%. So that is 0.75%, maybe 1% rate cuts in the US. So Wednesday's data is quite important for us, guys. Wednesday's data is quite important for us, because it's going to give us an idea what the markets expect from the Federal Reserve based on where inflation is going. So we have coming out on Wednesday, or is it Thursday? It's Thursday. US CPI. Does inflation keep going up or does it come down? More importantly, what does the core number do? It's predicted to go to 4.1%. If it does go to 4.1%, then that would show inflation keeps going lower, because it's gone from 5.7% down to 4.1%. And they're expecting headline inflation to go down to 3.6%. That's what they're predicting. Let's see if it happens. Okay, so if core inflation does keep going lower and the US economy remains fucking pumping these many jobs out, well, maybe the Federal Reserve won't have to keep interest rates as high for longer as they predict. Who knows? There's a lot of factors, guys, in these markets right now playing out. So basically, we got to keep our eyes on the bond market. We got to keep our eyes on the economic data. We'll get plenty more trades in to come. We've had a fucking good year so far. I mean, I've won 70% of my trades for all the trades I've taken since I've been sharing them with you guys. You can see here, here's the whole list of trades. I track every trade. Okay, so look, you can go through periods where you win 10 trades in a row, then you may lose 4. But overall, for as long as we're winning 70%, that's a fucking healthy win rate. So I'm happy with that. So next up, guys, what we're trying to do now is just see what the markets present to us. So we got our see what's happening with this war in Israel, and does it drag in Iran? Does it affect oil prices? That's why oil prices jumped higher today. There's a lot at play. So what I'm going to do now, guys, I'm going to do some research on Bloomberg. So I would advise, if you guys want to learn, come onto Bloomberg every day, as I do. Go to markets straight away and just read all of these fucking tabs. Oil surges as Israel conflict reignites Middle East volatility. There you go. You'll quickly learn why oil prices are going up. Iran concern grips emerging markets as Israel heads to war. One bond market is defying the global sell-off of record returns. You can read that. Yields set to slump with traders seeking havens. Okay, so basically, when there's war and investors don't like war, they buy government bonds as a safe place to park their money because stocks can fall. And when you buy bonds, it pushes up the price and the interest rate goes down. That's why today, the 10-year government bond yield in the US has gone lower today. Safe haven demand, pushing up the S&P. How long will that last? Who knows? All right, so I go to here, I go to the FX page, look at currencies. It's really good for you guys to read some stuff on the currencies. You'll get some really good articles in here about dollar gains as traders seek havens admit after Hamas attacking Israel. What else we got here? This is the article about why the dollar strength is likely to continue. You can read that. Speculators upped dollar longs ahead of the latest jobs report. There you go. I think they're talking about the COT report. Here you go. According to the commitment of traders commission data. See how Bloomberg's talking about that spreadsheet we updated, guys? And look, contracts on the dollar going up went from 2.8 to 7.2, as we had a look at. Bloomberg's doing an article. So let's actually read that article and see what it's saying. Speculative traders loaded up on bullish dollar positions ahead of the latest reading of US employment data, which showed hiring unexpectedly surged in September. Leveraged funds, hedge funds, basically, increased their net long position of the dollar for a third straight week, accumulating the most bullish stance since June on the currency. That positioning came just ahead of the release of the non-farm payrolls data on Friday, which topped economists' forecasts and bolstered the case for another Federal Reserve interest rate hike. The bullish stance highlighted the commitment of traders report data was built using short positions on certain group of 10 currency pairs, such as the euro, pound, yen. The data also includes quarter-end positioning that is typically among leveraged funds. Asset managers, meanwhile, have been rolling back their short positions on the dollar since the end of July. They are now the least bearish in about a year. So managers have gone from bearish to bullish on the dollar. You can see here, bearish. So they were selling the dollar to bullish. All right, guys. So look, we just updated these spreadsheets. I'm going to proper go through these charts now and look at some trade ideas. I'll find something, as I always fucking somehow do, and I will share them with you. I know I was going to say I was going to update you on what that trade happened on Friday last week, and I just did. So you guys can kind of understand what happened with Sorry, I didn't. So last week when we sold, which we had sold down here, we can see the bond market didn't keep rolling up and it actually rolled lower. And we got stopped out of the trade. And there was an article explaining there's a drug that I want. Basically, the tech stocks basically rallied last week Friday. Cut a long story short. I can't remember which tech stock it was. You know what? Let's have a look. Let's go Friday. I think it's important that we study our losses because we can learn from it. Right. Let's have a look. Okay, here we go. US stocks US stock market benchmarks rebounded after a tense week, while the retreat in treasuries extended. The Wall Street debated the odds of Federal raising interest rates again. The S&P advanced 1.2% Friday, with the benchmark snapping its 4-week of losses streak after a last-minute deal with auto workers union helped buoy sentiment. The Nasdaq 100 jumped 1.7%, with large cap tech names like including Microsoft, Apple, and Nevada Corp powering the index higher. It doesn't explain why. So it was a few tech companies that pushed the index higher, basically. And because of a deal between automakers. So, I mean, I couldn't predict that. So, yeah, that's pretty much what happened. All right, guys. So, hope you enjoyed this webinar. I'll do many more of these again. I'm going to record some videos and find some trades. And guys, remember, I'm actually doing. So I was going to do Top Golf with you guys on Saturday, but I got an email from Top Golf telling me I can't come. Basically, look, here we go. Why is it not opening? Due to availability this weekend, we are unable to host the event. So what I'm going to do, guys, I'm actually going to find somewhere nice on Saturday that we can all go for food and drinks. Come meet me in central London, guys. We'll just go for drinks and food and we'll all just have a nice night together. Let's get fucking drunk or whatever, get some food. I'm going to find somewhere tomorrow, think of somewhere nice, and I'll drop the location. We all just link up. Yeah, so we'll do that. And I've got a 2-day live course. I'm doing my first big workshop, okay, with you guys. Anyone who wants to learn how to trade currencies properly and go through all these spreadsheets, I'm going to do a 2-day event. There'll be about 20 spaces for people that want to take my course. I'll be teaching it face-to-face over 2 full days. It's a full day on Friday, full day on Saturday in London. And I've got something special where you guys don't have to pay for the course up front. So I know it's quite expensive for some people to spend like £1,500, but I've basically got a finance company now where you can make an application to pay for it over like 6 months, 8 months. You can pay like £150 a month over 10 months, for an example. So for you lot who would like to come, there's that option. For all of you that can afford to pay for it up front, come along. I'll be doing these regularly as well. So this is going to be fucking good, man. For you guys that want to take the advanced courses, now I'll be doing these workshops live, face-to-face, me in person, which is going to be good. All right. So you can inquire about that if you want to join. All right, guys. Have a lovely evening, man. I need to go get some food. Bless.